Did you know that 1 in 3 millionaires has made their wealth through investments in real estate? Or that Warren Buffett's favorite stock has been a slow, boring investment for over 30 years? If you're like most people, you probably think the rich get their wealth through high-risk, high-reward moves. But in reality, it's quite the opposite. The wealthiest individuals on the planet don't gamble with their money. They build it slowly, steadily, and patiently. In this video, we're diving into why the rich prefer boring investments. We'll uncover the strategies they use to grow their wealth, and why these boring moves make them richer over time. It's not about making quick cash or chasing trends. It's about making smart choices that stand the test of time. Stick around as we reveal the secret to wealth that most people overlook, and why playing it safe could be the key to your financial success. Chapter 1. The secret to their simplicity. Why boring works. The wealthy know a secret. Simplicity is the key to long-term wealth. They don't chase flashy investments or ride the latest trend. Instead, they lean into stability. Warren Buffett, one of the most successful investors in history, once said, "The stock market is a device for transferring money from the impatient to the patient." This sums up their approach perfectly. By focusing on simple, steady investments, the rich are able to build their fortunes without constantly worrying about the next big thing. Take real estate, for example. It's one of the oldest, most boring forms of investment, yet it's a favorite among the wealthy. According to a report by WealthX, nearly 40% of the ultra-wealthy invest in real estate, mostly in residential properties. Why? Because real estate offers consistent cash flow and appreciates over time. It's safe, predictable, and doesn't require the investor to constantly watch market trends. In the stock market, the rich often stick with blue-chip companies, those big, stable firms that have stood the test of time. These aren't the sexiest picks, but they offer long-term growth with relatively little risk. Buffett's Berkshire Hathaway holds significant shares in companies like Coca-Cola, Apple, and American Express. These companies may not be flashy, but they provide steady returns. Diversification is another key. Instead of putting all their eggs in one basket, the wealthy spread their investments across various sectors, assets, and countries. This reduces risk and increases the chances of consistent returns. They don't gamble with their money, but rather build wealth piece by piece. Chapter 2. Hustle and humdrum. Building wealth with the everyday. The wealthiest people often invest in what might seem boring to others, but their strategy is focused on the long term. They invest in everyday assets that generate passive income. Take index funds, for instance. These funds track the performance of the overall market and require minimal effort from the investor. Instead of obsessing over which stock to pick, the wealthy buy into the broad market and hold for years. Some of the richest people in the world, like John Bogle, the founder of Vanguard, built their fortunes by promoting index funds. Bogle's philosophy was simple: low-cost, long-term investments yield the highest returns. In fact, research from Morningstar shows that over the past 30 years, 90% of actively managed funds underperformed a low-cost index fund. The idea is to automate the investment process. The wealthiest people rarely check their portfolios every day. They make their investments and let them grow without constant intervention. The rich know that over time, the market will rise, and they don't need to worry about the daily fluctuations. Furthermore, successful people invest in themselves. They use the wealth they accumulate to fund businesses, acquire properties, or fund ventures that will pay dividends for decades. The everyday hustle becomes less about chasing short-term gains and more about setting up systems that create wealth over time. Chapter 3. Why risk is a luxury. The calm mindset of a billionaire. Risk, for the rich, isn't about taking reckless chances, it's about managing it. The wealthy are not risk-averse, but they are risk-aware. They take calculated risks, but they rarely gamble. This mindset is built on knowledge and experience. A quote by Charlie Munger, Buffett's right-hand man, illustrates this point well. The wise man looks for what he can learn from others, and the ignorant man looks for what he can teach others. The wealthiest individuals often prefer investments that offer predictability over the ones with potentially higher returns but greater volatility. For example, treasury bonds, while considered boring by most, provide guaranteed returns over time and are a safe haven in uncertain markets. In contrast to the excitement-driven investing strategies of many everyday traders, the wealthy are calm and collected. They understand the principle of compounding. Albert Einstein famously called it the eighth wonder of the world, and the wealthy embrace it. They make slow but steady investments that grow exponentially over time. According to research by the Swiss bank Credit Suisse, the wealthiest 1% of people have consistently seen an average return of 6% per year on their investments. While this may not sound like much, the compounding effect ensures that their wealth grows significantly over time, without needing to take on massive risks. If you're enjoying these insights, don't forget to subscribe for more tips on building long-term wealth. Chapter 4. Patience Pays. The Wealthy's 10-year investment playbook. Time is the greatest ally of the rich. They think in terms of decades, not months. While most investors jump from one trendy stock to another, the wealthy take a much longer view. They aren't looking for quick profits, they're after long-term growth. The magic number? 10 years. The wealthy understand that true wealth is built over time, not in a single investment cycle. A study by the Motley Fool found that the S&P 500 has delivered an average annual return of 10% since its inception. Those who stuck with it over the long haul saw their investments grow significantly. Consider Jeff Bezos. When he started Amazon, it wasn't the coolest company. It was just an online bookstore. Bezos spent over a decade reinvesting his profits to grow the company, often at the expense of immediate returns. But his patience paid off. Amazon is now one of the largest companies in the world, and Bezos is one of the richest people alive. The wealthy know that the more time they give their investments, the better they will perform. This is why they prefer low-risk investments like index funds or government bonds, assets that offer long-term, consistent returns. In fact, the average millionaire holds a stock for about 7 years, according to a study by Thomas Stanley, author of The Millionaire Next Door. Chapter 5. Money moves like a slow river. Why they stay in their lane. The wealthy aren't in a rush. They move like a slow river, steady, deliberate, and constant. They focus on what they know, and they stay in their lane. This is why they prefer investments that don't require constant changes or attention. A slow, predictable income stream is far more appealing than a high-risk venture with uncertain returns. This mindset is especially apparent in the real estate market. Many billionaires, like Elon Musk and Mark Zuckerberg, invest heavily in land and property, knowing that these assets will appreciate over time. Real estate is a slow investment compared to tech stocks, but it offers consistent returns without the volatility. Take Ray Dalio, for instance. The founder of Bridgewater Associates is known for his focus on diversification. He's built a portfolio of assets that range from stocks to bonds to commodities. Dalio's approach is simple. Spread your bets across various sectors to reduce risk. His Bridgewater Pure Alpha Fund, which has returned over 12% annually since 1991, thrives on this steady approach. The wealthy understand that investing is a marathon, not a sprint. They build wealth slowly, with few surprises. They aren't jumping from one trend to the next. They are creating a solid financial foundation that will stand the test of time. Chapter 6. Teaching the Boring Way. How wealthy people pass down their knowledge. Education plays a huge role in how the wealthy maintain and grow their fortunes. But it's not just about teaching them how to make money. It's about teaching them how to make money grow. Wealthy families often pass down not just money, but a mindset. This mindset is rooted in simplicity and patience. Many wealthy families have a tradition of investing in long-term, low-risk assets. For example, the Walton family, owners of Walmart, has kept the majority of their wealth in low-risk, stable investments like bonds and real estate, ensuring that the family fortune will last for generations. In addition to traditional investments, the rich teach their heirs about financial independence and responsibility.
According to a study by the Williams Group Wealth Consultancy, about 70% of wealthy families lose their wealth by the second generation, and 90% by the third. The key to success is education, teaching future generations the power of consistent, boring investments. This education focuses on understanding the financial landscape, managing risk, and thinking long-term. The wealthy teach their children to be patient, just as they were taught. Instead of spending on luxury goods or short-term pleasures, they focus on building sustainable wealth that lasts. Through this method, the cycle of boring investments continues, and wealth is preserved for generations. The lesson is clear: slow, steady, and reliable wins the race. Don't miss out on future insights about wealth building strategies. Make sure to subscribe and join the community.